Did you know that a single investment could give you access to hundreds of different securities like stocks and bonds? That's the power of mutual funds, a financial tool that has been helping people grow their money for nearly a century. Back in 1924, mutual funds made their debut in the US, but it wasn't until the 80s and 90s that they really took off. Today, they're one of the most popular investment choices, offering a way for regular people to get a piece of the financial markets without diving into the complexities of stock trading. But what exactly are mutual funds and how do they work? Let's start by understanding the different types. There are four main kinds: stock funds, bond funds, money market funds, and target date funds. Each has its own rules, risks, and returns. Stock funds focus on the stock market. They vary widely. Some target specific market indexes, others pay regular dividends like income funds, and some specialize in industries like tech, known as sector funds. Bond funds invest in bonds, which are essentially loans you give to a company or government that they pay back with interest. Bonds are generally safer and less volatile than stocks, offering predictable returns. Money market funds are the safest bet, investing in low-risk securities like treasury bills or T-bills for short, which are like IOUs to the government with terms that can last up to 52 weeks. This type of fund acts as a short-term parking spot for cash, offering stability but lower returns. Then there are target date funds, designed for long-term goals like retirement. These invest in a mix of stocks, bonds, and other securities and automatically adjust their risk levels as you get closer to your target date. With all these options, you may be thinking, well, what's the best one and the most popular? We can't tell you which option is best for you, but we can tell you how a mutual fund works and why it's one of the most popular investment vehicles in the US. Mutual funds pool money from multiple investors to buy a diverse mix of stocks, bonds, or other securities. It's a bit like a financial potluck where everyone contributes to buy a larger, varied basket of investments. This setup means that investors don't directly own shares of any specific companies. Instead, they own shares of the mutual fund itself, which holds the actual investments. Now, this might sound a bit limiting, but it has its perks. By spreading money across many different investments, mutual funds lower the overall risk. So, if one stock in the fund takes a hit, others might perform better, balancing out the impact. It's a strategy that provides a relative safety net for your money, making mutual funds a popular choice for those who want steady growth without the risks of individual stock picking. But how do you actually get into mutual funds? You can buy shares through a brokerage firm, or as most people do, through a 401k retirement account. Most funds have a minimum investment, sometimes as low as $500, but it can go up to thousands. And of course, like all investments, there are fees involved. These could include transaction fees, management fees, and others that vary depending on the fund type and class. So it's important to do your homework and find low-fee options, unless you're someone who enjoys riding high with high fees. Speaking of management fees, let's talk about who manages these funds. Most mutual funds are overseen by portfolio managers. These professionals actively buy and sell shares, aiming to outperform the fund's benchmark, which is a set standard used to gauge the fund's performance. This active management can be great for boosting returns, but it does come at a higher cost, making these funds pricier than others. So, how is the price of a mutual fund calculated? It all really comes down to something called the net asset value, or NAV, for all the finance gurus out there. This is the overall value of the fund's investments divided by the total number of unsold shares. It changes daily based on the performance of the securities within the fund, so the price you see today might not be the same tomorrow. So why do people invest in mutual funds? For one, they provide diversification without the hassle of managing individual stocks. They're particularly attractive to risk-averse investors who prefer a hands-off approach. And while mutual funds generally offer higher returns than traditional savings accounts or CDs, they also come with drawbacks. On the downside, mutual funds can limit your potential rewards. Since you don't own shares in individual companies, you won't see the full benefit if one company performs exceptionally well. Plus, the fees associated with mutual funds can eat into your returns. If this video sparked your curiosity, give us a thumbs up. And if you'd like to continue down your path for knowledge, don't forget to subscribe for more fascinating content like this.